And we're definitely in several bubbles right now, all of which will deflate. There's never been a bubble that didn't reverse. Hey guys, I'm back in the studio. We're going to get rolling now. A lot of things built up over the long weekend. Had a great long weekend. I was in Detroit with my girlfriend Jane, and we just had a wonderful time. I'm recharged, I'm refreshed, I'm back at it. Let's get into it. So I have a whole bunch of things that built up I want to go over with you. It's going to be a kind of disjointed video, but it's all about the economy and you. Everything's always about the economy and you. And I got to take you through a few of the headlines here. CNBC's homepage. It's around noonish on Thursday, September 5th. Dow falls 300 points as recession fears simmer ahead of major jobs report. That's everything I'm telling you about in this video. There's major protests going on in Israel, significant, and against Netanyahu. People already before October 7th, they didn't even like Netanyahu. He's probably going to go out of power. But now, with the 6 bodies of hostages they just found yesterday or the other day, the people are fed up with Netanyahu, who happens to be, as I've told you, benefiting as long as the war continues. And I'm not saying that the war isn't necessary or isn't necessary. I'm not having a horse in this race. I'm just saying that there's a moral hazard that Benjamin Netanyahu is going to have a lot of problems and almost certainly lose his job as soon as this war is over. And since he has the power to extend the war, that's part of the reason that it's certainly going to keep on going and grow from here. And somebody said a comment that I have to address, because in my videos you'll notice that a lot of what we say is that the Peter Leeds newsletter is one of the most popular financial newsletters of all time. And somebody made a comment that we all know that's not true. And I sat there for a minute and I thought, oh my God, do you guys think I'm just blowing smoke here? Everything I talk about, the media stuff, everything, it's all verifiable if you want to spend the time. But it is one of the most popular financial newsletters of all time. My record is that we got one time 82 new subscribers in one day. That was closer to the dot-com bubble, but still, it was a pretty good day. For my American friends, Tim Hortons is a big Canadian coffee shop. It's going into the States now too. There's some in Michigan. But check this out. Just going to pick up your daily Bear Claw or your cruller. I also want to show you one of the last alerts I put out to my subscribers, because it was just a perfect clip of a screenshot of CNBC homepage. I just grabbed it. I go, because this is a representation of what it looks like as everything I've told you about is all happening. And there's a whole bunch about the economy we're going to talk about today. Some new numbers came out, and it's just telling my story even more, even louder. And you guys are still here, so I think you believe and understand that I'm not wrong about all this stuff. Friday, we get the jobs report. Tuesday, there's the debate, which I'm not a political dude. I'm not a guy who watches the debate. This one, I'm going to watch. I have to cleanse my palate after that last debate, which was one of the most cringy things I've ever seen with Biden and Trump. And so I want to see a proper, good debate. So I'm going to watch it. I think it's going to be interesting. Not sure. Maybe it'll just be boring. But here you can see red across the screen here. We'll check out how is oil doing. Up 1%, no biggie. Gold, up $11. Silver's up 2.23%. And later this month, in the next few weeks, we have the Federal Reserve interest rate decision. They're obviously going to lower rates. But everyone knew they're going to lower rates. And then gold prices go up pretty strongly today, and there's a headline that, because they're going to lower rates. I don't understand how come people don't get ahead of this and get upstream. If you know something's going to happen and then it's going to cause things to benefit, position yourself so that you're sitting there and you just get the profits. We've got a big jobs report coming out on Friday, which is going to show more of the same, which is echoed by 2 of the headlines I'm going to tell you about right now. And here's a great question I got from one of our subscribers in Germany. He has read the Penny Stocks for Dummies version in German, and I have no idea what it says. I'm not involved with the translation, so hopefully it's correct. Anyways, he asked a question about how they merged the OTCBB market, the over-the-counter bulletin board, which is owned by NASDAQ, So it was a really high quality market, even though the prices of the shares were low. Everybody who had a good company tended to try to get onto the bulletin board. And then there's the dark markets, OTCQX, OTCQB, which are terrible because there's just an unlimited bottomless supply of garbage companies. I'm talking about more than 95%. So maybe 96. A lot of bad companies migrate to the places where it's easiest to have a company listed. A lot of people lose a lot of money. Almost everybody's going to lose money in the dark markets. And what they did is they took the dark markets and the bulletin board, and so they combined it like a good thing and then a pile of dirt. So this made it into a big mixed up pile of dirt. The question was from Michael in Germany about what is going on now with the markets. And this is why I don't want to write the 4th edition of Penny Stocks for Dummies. I don't want to be the one because I have to rewrite the entire book because everything I said was about trying to find the good stocks at low prices on the good market. And now, as you'll see in my reply to him, I'm still upset about all of this. They took a good market and swept it together with the garbage. It makes our job so much more difficult. It comes down to a stock-by-stock analysis. All of the markets are awful now, but there are very few diamonds in the haystack. Now this is from CNBC. August private payrolls rose by 99,000, smallest gain since 2021 and far below estimates. Companies hired 99,000 workers last month, less than the downwardly revised 111,000 in July, and below the consensus forecast for 140,000. The report corroborates multiple data points recently that show hiring has slowed considerably from its blistering pace following the COVID outbreak in early 2020. Private sector payrolls grew at the weakest pace in more than 3.5 years in August, providing yet another sign of a deteriorating labor market and proof of everything that Peter Leeds has told you for a couple of years now. This is just more of the same of soft, weak economic data keeps coming in, and sometimes it comes in kind of strong, it looks good, but then they revise it down later after the fact, or it comes in weak and then they revise it down from there even further, and sometimes they don't revise it. But there's a lot of misinformation and gaslighting about the economy. Friends of mine talk about how good the economy is. And I don't get into this stuff, but the economy is weak. It's always been weak. I've showed you why it's weak. I show you how it's getting weaker. You can watch how it continually gets softer and softer. You guys have learned all of this from me. If you weren't paying attention, then go back and watch it because everything is playing out about the so-called strong economy right now, and things that I told you would happen, such as, like the unemployment rate will start rising, and then now I'm showing you how it's doing it. Now everybody's talking about it, and they're all being surprised that, maybe we will have a recession. Maybe the economy is weaker than we realized. And if you know it ahead of time, you can position yourself to benefit from that. Copper is one you're going to want to watch. This is related to a stock I have to tell you guys about coming up. This copper prices. A lot of this weakness has to do with the economy slowing down, but a lot of commodities will scale down a bit and then they'll build a base and then they will recover strongly for many years. Job openings fell more than expected in July, and another sign of labor market softening. The department's closely watched job openings and labor turnover survey showed that the available positions fell to 7.67 million on the month, off 237,000 from June's downwardly revised number and the lowest level since January 2021.
The Peter Leeds newsletter is one of the most popular financial publications of all time.
Economists had been expecting 8.1 million. With the decline, it brought the ratio of job openings per available worker down to less than 1.1, about half of where it was from its peak of more than 2 to 1 in early 2022. I told you guys about this. There were so many job openings that there weren't enough workers to fill it, and that puts a lot of pressure. That squeezes the unemployment rate lower. Anybody who wants to work can get a job, but that's all about the change, and everyone's acting so surprised. And I told you why it was going to change, and now it's playing out exactly like that. And just remember that the great stock market crash of 1929, they were in it for many months before they even realized that the market crash had begun.
And it sounds very similar to nowadays, in my opinion.
The bond market yield curve returns to normal from an inverted state that has raised fears of recession. Yes, what happens is that the yield curve inverts. And what that means is that you get a shorter term bond and it pays more interest than a longer term bond. That's the opposite of what it should be. You invest money for 10 years, you want to get paid more than if you had made the same investment for 2 years. But it inverts, and that is a signal of recession. It doesn't make the recession happen. What happens is every time there's a recession, you can look back and find the inverted yield curve. But what happens then, before the recession starts, almost every time, and as it's happening exactly right now, is that the yield curve uninverts, it goes back to normal, and that often is when the recession gets rolling, gets into full steam.
You can see the US dollar weakening here compared to the Japanese yen, weakening compared to the euro, weakening across the board.
The relationship between the 10 and 2-year Treasury yield briefly normalized Wednesday, reversing a classic recession indicator. Following economic news that showed a sharp decline in job openings and dovish remarks from Atlanta Fed President Raphael Bostic, the benchmark 10-year yield inched above the 2-year for the first time since June 2022. Do you guys notice that all these headlines that we're talking about, it keeps going back to for the first time since 2021, 2022. And it's all about the pandemic trade. The economy closed down and then it reopened. So the economy got really bad and then really good. And we had that stupid little mini recession that lasted for, I think, 5 weeks.
Cryptocurrencies down a couple grand to Bitcoin's at 56,000. Layoffs jump in August while hiring is at a historic low. You see how OPEC and OPEC Plus can control oil? That's why you don't worry too much when prices drop. They are dropping really strongly because of the economy weakening, but then OPEC can just come along and say, you know what, for example, let's delay the production boost that we had promised. And all of a sudden the price of oil goes up 2%. I'm not going to touch this with the 10-foot pole.
But whatever you're reading now, everything's pointed to it's the worst since after the reopening trade. Something is setting up right now that you can feel it. And I know you can feel it if you're here watching these videos. Remember to subscribe, by the way. If you're watching these videos, you know we are in absolutely uncharted waters. And the 4 most dangerous words in the stock market are, it's different this time. I know, and I agree, and it's true. But what is different this time? And I hate to say it, but this is the first time that every single currency on the earth is a fiat currency, and we've never been in that situation, so you don't know what's going to happen. And we're definitely in several bubbles right now, all of which will deflate. There's never been a bubble that didn't reverse. It's always about timing. That's when you make the profits. That's what I tell you about how it's about the speed of the slope or the trend rather than the actual destination. If interest rates go to 0 and they do that over 5 years, it will almost go unnoticed. But if they're dropping to 0 in 2 meetings, that's going to be much more meaningful and have much more effect, whether for better or worse. Here's a screenshot from CNBC, the 10-year Treasury yield versus the 2-year. When the 2-year pays more, that's an inverted yield curve, and it just recently normalized. It should still pay more. The 10-year should still pay a lot more than the 2-year, but technically just go by, it's a little bit higher of a payment. So it's now not inverted anymore. An inverted yield curve in which the nearer duration yield is higher has signaled most recessions since World War II. The reason why shorter duration yields rose above their longer duration counterparts is essentially the result of traders pricing in slower growth out in the future. So the yield curve inverts when traders are expecting things to slow down. As I showed you with the leading economic indicators, that they're all telling you that. And the results, all the financial reports coming in are awful. Things like manufacturing, the balance of trade, debt levels, the operating deficit of the country. There's so many things that will not allow us, until they get fixed, they will not allow us to have this pie in the sky, rainbows and unicorns and sunshine view of what's going to happen to this economy, to the US dollar, and to this stock market. However, a normalization of the curve does not necessarily signal good times ahead. In fact, the curve usually does revert before a recession hits, meaning the U.S. could still be in for some rough economic waters ahead. I would say that that is the worst use of the word could in the English language ever. He should have said will. And the people that read it that way are going to do a lot better out of what's about to come than most of us. This is going to be a once-in-a-generational complete adjustment of the entire global financial system. And in all that, if you're not holding on to a little bit of gold or silver, some kind of investment related to that, you're going to definitely land in a worse place than you could have. And you guys know that I always ask you for some support. The reason you're not seeing ads here, the reason there's no sponsors, we need people to support the channel. And if you do it, you get a free newsletter. I'm asking you guys to be a Peter Leeds Insider. You get direct contact with me by email, ask me anything you want, and you get the special exclusive newsletter for people who are Peter Leeds Insiders. So consider tossing in a couple bucks, the cost of a cup of coffee, to help support the channel, as so many others have that have benefited you already.